corners of Capital Link, and I would like to welcome you all to Capital Link's Invest in Greece webinar series. Today's webinar will be on the topic of the Greek stock market in a new era. And we have with us the heads of research of four major Greek securities firms. And the moderator is Mr. Trevor Yates, investment analyst at Global X ETFs. I will turn the floor over to Trevor, and he's going to introduce our panelists. I would like to thank you all for being with us. Two very quick remarks. The first one is the traditional disclaimer that this presentation is not meant to be investment advice or advice of any kind. It is done purely for informational and educational purposes. And the second one on logistics. We will start with a brief presentation by Trevor, then we have a Q&A among the panelists, and you are welcome to submit your questions anytime during the webinar. You have a button at the bottom of your screen, and you can submit your questions that way, and Trevor and the panelists will reply to them at the end of their roundtable discussion. And with this, I would like to thank you all again, and I turn over the floor to Trevor.
Thank you, Nicholas, and hello, everyone. Welcome to the Greek Stock Market in a New Era webinar. As Nicholas mentioned, my name is Trevor Yates. I'm an investment analyst at Global X ETFs based out in New York, covering emerging market international equities, and I will be moderating this discussion. But before we get into the Q&A portion of the webinar, I have a few slides to provide a quick update and some background on the Greek market. I can share my screen here. Perfect. So over the past 2 years, we have seen strong outperformance by Greek equities, outpacing gains in both the S&P 500 and the broader emerging market index. Greece was also the fourth best performing single country ETF in 2023, returning nearly 43%. From a broader and more high-level perspective, this has been driven by a mix of the market-friendly political backdrop and positive election results, which saw the New Democracy Party winning a majority in parliament in 2023. We have seen continued strength in the tourism sector, as well as the continued flow of the EU recovery relief funds. And this is in addition to the many bottom-up and sector-specific drivers we will get into more detail later. And all this has resulted in above-average GDP growth, all three major rating agencies upgrading Greece's sovereign debt rating to investment grade, Greek banks being able to pay dividends for the first time since the GFC, and Greece's largest IPO since the crisis. All this to say, the turnaround is well on its way, and as you can see in this chart, markets have been rewarding this strong progress. However, despite the strong performance, Greek equities remain cheap, trading below their tangible book values and below their historical average PE. This is despite solid return metrics, as well as the index offering an over 6% dividend yield. The banking sector in particular sticks out to us, and as you can see on the chart on the slide, the Greek banking sector trades at a discount to peer markets. And this is despite the strong momentum, with ROEs improving from near 0% in 2020 to over 12% today. So as a result, we see prices diverging from fundamentals, making Greece an attractive value opportunity. And in addition to remaining attractive from a valuation perspective, we see Greek equities as under-owned. So doing some quick back-of-the-envelope math, if the typical portfolio has 5% exposure to the broader emerging market index, asset managers only have 2 to 3 basis points of their entire portfolio in Greek equities. So we see ample room for catch-up on the positioning side, with the potential for investors to supplement their Greece exposure within their emerging market or broader Europe allocation through a country-specific fund. And looking ahead, we see a potential upgrade to developed market status by MSCI as a potential catalyst. Although Greece wasn't included in this year's review, we see this upgrade as increasingly likely moving forward, and we expect this to drive significant capital and flows to the market, as well as further increased liquidity. And then now, just looking at the Athens Stock Exchange at a glance, the Greek market offers a broad and diverse exposure to the Greek economy, with the main index having over 60 constituents and no company comprising more than 11% of the index. Liquidity is strong, trading over 147 million euros a day and rising, while equities have solid international ownership. Despite these attractive metrics, we see the below peer market cap to GDP ratio opening up potential for increased capital market activity moving forward, which should result in a larger and even deeper market. Now, with that, we will be moving on to the discussion. I'm very fortunate and excited to be joined by four experts in the Greek market. With us, we have Panagiotis Kladis, who's the head of equity research at Alpha Finance Investment Securities, Alex Boulougouris, who is the head of equity research at Euroxx Securities. We have Vangelis Karanikas, who is the head of research at MBZ Securities, and Natasha Roumantzi, who's the head of equity research at Piraeus Securities. So let me stop sharing my screen. And as Nicholas mentioned, if you have any questions, please write them in the Q&A box and we will get to them if time permits. So to kick things off, the title of this webinar is The Greek Stock Market in a New Era. So I'll open this up to the panel. I'm curious, what particularly makes Greece such an attractive market? And despite the rally, are we still in the early stages or earnings of this so-called new era?
Okay, let me try to answer this. First, let me thank Capital Link for providing this opportunity today to speak about the prospects of the Greek market. And I think, Trevor, you showed us some very good points that we could use to answer this your initial question. From our perspective here at Alpha Finance, a year and a half ago, we issued a strategy note that in which we argued that the Greek market is entering into a virtuous cycle. So for those not following the Greek market for a long time, this market suffered for more than a decade, roughly between the global financial crisis and the pandemic. Most of this was due to our domestic problems, but it was a market with very low valuations, distressed valuations, very thin liquidity, very few names to trade, and so interaction with the investment community was extremely low. A couple of years ago, we felt that this has completely changed. We thought that most of the key factors are aligned in the sense that we felt that we have a stable political environment, a very good macro backdrop, companies that have survived the crisis and are taking advantage of either the macro conditions or other themes. And we argued that the Greek market is entering into a virtuous cycle, which the way we translate this is that we will see valuations start picking up, which will give the incentive to either listed companies or companies that not listed to take advantage of the market and proceed with an IPO, which in turn would result in a market which would be broader, so more names to trade, and deeper, so more liquidity, and that in turn should attract more investors. So, a year and a half later from this strategy note, we feel much more confident to communicate the same message. We think that indeed we have entered a virtuous cycle. We have seen a number of IPOs and placements during the last year, very good returns, much more liquidity in the market. And looking ahead, I think given the fact that all these factors that I mentioned before are still in place, macros seem to be very healthy. Political environment also, it seems solid at the moment. Earnings are either growing or are coming from high levels, so they are expected to remain overall strong, and valuations we feel that have not fully reflected the prospects of the Greek market. So we are, to answer to your question, at least from our side, we think that we are still at an early stage of this positive cycle.
Perfect. We recently had, last year we had elections in Greece with Prime Minister Mitsotakis and his New Democracy
Trevor,
Party.
sorry to interrupt you. If I may
Yeah.
add, perhaps on this one, another.
Sure.
Hi. Let me take this opportunity to thank Capital Link for the invitation for this very interesting event. And regarding the Greek stock market attractiveness, as you mentioned, I would like to stress one important factor, which I believe is a return of investor confidence on the Greek market and economy as a whole. As everybody knows, confidence is important for stock markets. And this has happened after quite many years that the investors did not want to hear much about Greek stocks. So I believe this change has been the successful result of two factors. Firstly, it was a culmination, let's say, of a remarkable macroeconomic adjustment, solid credit fundamentals and fiscal credibility, supported by Greece's strong and resilient economic recovery, and remarkable improvements in the banking system and the continued implementation of reforms. And secondly, it was also the result of systematic efforts by selective quality Greek corporates to improve their fundamentals, amend their balance sheets, and turn more extrovert and investor-friendly during tough conditions, especially during the COVID period. So I believe these two factors have strongly increased the appeal of the Greek stock market, leading it to a new era. Thank you, Trevor. Back to you.
Perfect. Thank you both. So we had elections in Greece last year, and Prime Minister Mitsotakis and his New Democracy Party secured another term. So maybe starting with either Alex or Panagiotis, what does this political backdrop mean for your equity market outlook?
Well, I think that thank you first of all, Trevor, for the question, and thanks Nick for the link. I think that the political change and the introduction in 2019 of a new government providing stability was also instrumental in bringing this market improvement that Vangelis and Panagiotis mentioned earlier. I think this has been very important political stability because Greece went over the past 10 years during the crisis in significant political instability with many government changes, and all that, of course, was made it impossible to bring change. This has been evident over the past 5 years, and it seems that we are in a path that political stability is visible for a long period of time in the Greek market. Maybe even unlike other European countries that face more political stability compared to the Greek market at the moment. So I think this has been very important. And this political change and political stability, more I would say, combined with a market-friendly government overall, has provided this improvement. And of course, I think this is important also for the estimates going forward. We have seen Greece growing well above EU averages constantly for the past few years. We think this is visible and feasible to continue in the following years. We expect the Greek GDP to grow well above EU averages in 2024 and 25, and this is evident already by the EU forecast, IMF, and other independent forecasts, I would say. So we are quite confident that this will be evident also in the market as well gradually. We have already seen that, but I think this will continue going forward.
And if I may add, Trevor, it is important, just a few points. First, that in last year's election that you mentioned, we saw this government gaining an even higher percentage compared to the first one, which is not common. And more importantly, given the fact that it was a government that from the first day or they came out to power with a reform agenda, it is like, the Greek people gave them the mandate to proceed with a reform agenda. So that was a very important shift, if you like, in the way that people in Greece are electing a government. The other important thing is that for the next 3 years, we don't have any other election. We had recently, as you know, the elections for the European Union Parliament. We saw their percentage was much lower than a year ago, but still nearly double compared to the second party. So the next 3 years are clean. We don't have any elections, so it's a great opportunity for this government to keep reforming the economy. As Alex mentioned, it's very fortunate for this country to have now a stable political environment, which was not the case in the previous decade, and is not the case in many other European Union countries. And obviously, for the longer-term investors, no one could predict what will happen in 3 years' time when we have again elections. But one thing that we believe during the crisis has been built in this country was institutions, which means that even if you have a different government in place, there are some things that will keep taking place. Obviously, we are not at the level that at an ideal level, but the improvement compared to before the crisis or even during the crisis, I mean the domestic crisis, I think anyone could see that institutions are much better. So that is also a guarantee for the longer term, I would say.
Okay, thank you both for that. So Greece's sovereign debt rating was recently upgraded to investment grade. There's also been a lot of talk surrounding MSCI potentially upgrading Greece to developed market status over the coming years. So maybe starting with you, Vangelis, can you please offer some insight into the significance of the debt upgrade and what an eventual reclassification to developed market status would mean for Greece and Greek equities in general?
Sure, Trevor. I'll start with the investment grade, which I believe the significance of this upgrade after almost 13 years cannot really be stressed enough. It is indeed an important milestone for Greece, affecting everything, the whole economy, capital markets, businesses, and households alike. In my view, perhaps the most obvious benefit from regaining investment grade will be the de-escalation in GGB yields, resulting in reducing the cost of borrowing and better liquidity conditions for the states, the banks and the Greek companies in general. This lower borrowing cost could also offer partial mitigation against the negative impact on Greek households from recent interest rate hikes. And also the transition should strengthen the pass-through of the anticipated future reductions in interest rates to the whole economy. Now, Greece's return to the investment status has also enabled the Greek debt to be eligible for international IG-only government bond indices, starting with Bloomberg and followed by S&P, Dow Jones, FTSE, and JP Morgan. And I believe this has resulted in attracting steady demand from a much larger pool of global investors. And the same holds true for the corporates. For Greek banks in particular, we've seen real examples. The investment grade has led to a large reductions in the spreads they have achieved in the recent MREL bond issuances, leading to cost savings. Additionally, the Greek banks' return to investment grade will be major qualitative leap, making banking debt eligible for considerably higher size and better quality investment portfolios, while also allowing the ECB to formally accept GGBs as eligible collateral for any current or future programs. And turning to the capital markets, one of the most obvious benefits for the stock exchange, except for the return of investor confidence, is the fact that Greek equities will once again become an investment option for a variety of institutional investors that have mandates to only invest in IG securities, most often long-term investors, quality investors such as big pension sovereign funds and insurance, among others. Lastly, as you said, the IG has been a major prerequisite for the upgrade of the of the market to developed status. And I don't know, perhaps if some of my colleagues would like to comment on these recent developments. We've seen MSCI not putting us on a watch list a couple of days ago, and perhaps discuss the debate around this issue. Trevor?
Actually, I wanted to make a general comment on this regarding whether Greece will be moved to developed market status, because I think that what's important is not so much the upgrade itself, but all the necessary reforms that the Greek market should implement towards this goal, such as the new stock market and regulation that aims to improve marketability, the depth, the market depth, liquidity, and also this initiative that the government, in collaboration with other stock exchanges, will take regarding providing tax and development incentives to grow businesses through M&As. So all this, so regardless of the timing of the upgrade, in the process, the Greek market will gain depth, will become more liquid, marketability will improve, it will probably have bigger companies, and with the growth of the economy, will maintain in the focus list of investors. So that's a general comment for the market.
I could also add here, Natasha, that regarding the significant amount of placements, IPOs we have seen recently, so this is likely to continue going forward. I think we could see more companies entering the Athens Stock Exchange, and this, of course, will increase investability, free float, liquidity in the exchange, and will make also, I guess, in the future also the potential of gaining this MSCI developed status more visible going forward. Even if it didn't happen this year, it may happen going forward, of course. We've already seen the IPO of the Athens International Airport, the increase in the free float in the banks, and I think probably there is more to come gradually with new IPOs and new issues ahead.
And if I may comment on the debate, I guess the debate stems from the fact that the market, the size of the market is still relatively small. So there is an opinion out there that it does not make sense the way it is right now, the Greek market, to be promoted into developed market. But I guess it's not a static discussion; it's a dynamic discussion. So as Alex mentioned, sometime in the future it could take place, probably with a number of additional IPOs and even bigger sizes of the current listed companies. It may make more sense in the future. And just again, for those that are not following the Greek market for a long time, in the past, the Greek market was in advanced status since from 2000 to 2010. If you exclude the last couple of years when we had the global financial crisis and we had the early signs of our own crisis, it was a period that we had a very active market, a lot of names to trade, much higher valuations, and much higher trading activity. So in other words, it was a much deeper and much broader market. So hopefully the way forward is to reach again to that point. It is obviously a matter of not a year, it is a matter of some years, but down the road, I think all of us, we could agree that this is the way forward for a country like Greece.
And Trevor, if I may add to what Panagiotis has very interestingly said, there is also about the debate, this argument, the big fish in a small pond. People argue that upon upgrade, the Greek market will carry significantly lower weight in the developed market indices compared to larger weights it currently carries in emerging market ones. Potentially leading to net outflows, but I think nobody really can estimate exactly the net impact in terms of inflows and outflows. It's still too early, and I think in longer term it could turn more positive.
Perfect. Thank you all. And just as a reminder, if anyone has any additional questions, please feel free to put them in the Q&A box at the bottom of the screen. So maybe now shifting to more the bottom-up story. How does the Greek market as a whole compare to peer markets from a valuation perspective? And I mentioned banks earlier in my presentation, but do any particular sectors stand out to any of you?
Yeah, maybe I could mention. I mean, clearly the banking sector is, I think, clearly still very undervalued. We've seen the in price to book, but also in a PE ratio where it trades at 4 to 5 times earnings, depending on the bank. We see European banks closer to 7.5 times earnings. So clearly a significant valuation gap compared to the peer group. But also other sectors, I think we see that being the case. I think it is clearly evident, although the other sectors are not, Greece is a small market and may have individual names. So I don't think you can look at big sectors outside the banks so clearly. But we see on an individual basis that, as you said in your presentation as well, that the whole market trades at a PE discount compared to historical averages and European peers. The dividend yield is now strong, not only in the banks as well. Gradually, it's becoming very evident that the dividend yield will be very high, but also in the non-banks. We've seen in recent transactions, for example, with Terna Energy and the acquisition from Masdar, that valuation multiples are pretty solid. So there is a strong demand, and I think that current valuation in many of the non-banks as well is pretty low.
I think what we could say here is that for those investing in Greece over the last few years, valuations obviously are not where they were a few years ago, when you could find very interesting valuations, but they are obviously not at the distress levels now. But I fully agree with Alex that you can find still some very good valuations, especially compared to the anticipated profitability of these companies. I guess banks and energy sectors, energy being a number of not exactly the same companies, but with a broader meaning of energy. You can still find some very interesting valuations. And as you said, for the market as a whole, we are still trading at a discount. Even if you look at it from a historical perspective, of course, It's not, we were through a period that earnings were not that stable. There was a lot of volatility. But even if you compare it to our historical standards, or if you compare it with other big markets, we think that there is still room to grow in terms of valuation. So there is still room for re-rating.
And if I just may add something on this, so regarding non-financials, we also observe some really attractive relative valuations in the broader industrial space. There are few representatives in the Greek market, like Metal and Energy or Herbal Hardcore, and also in the telecom sector, where OTE has been traditionally trading at quite big discounts relative to its European peers in almost all important metrics.
Perfect. Maybe sticking with the banks, since we have very a lot of bank analysts, and we're fortunate to have it on the call. But maybe thinking of the discount versus EU peers, it's like I showed on the graph in the presentation, better return metrics, and it seems that we've been discussing this whole webinar how a great top-down story. Do you think Greek banks deserve to trade at a discount, and could you even argue that a premium versus EU banks is warranted?
Okay, I can start on this, and my colleague back analyst could add on this. Actually, okay, we all know that the sector is now clean, well capitalized, profitable, and actually banks have accumulated capital during the last couple of years. So they can use this capital to grow their lending books, largely to give loans related to RRF related projects, also to make acquisitions either in Greece or abroad. We could mention the example of Eurobank that acquired the Hellenic Bank in Cyprus, also make acquisitions in other segments of the financial sector, like in the asset management market segment or in the insurance sector. So this is quite important, the fact that the sector is clean, well capitalized, profitable, and has capital to grow either in Greece or abroad. Especially, I want also to add another potential catalyst for the sector, which is the fact that there is a pool of loans outside the banking system, and these loans are currently managed by the servicers, and they total close to 70 billion. And these loans could eventually return to the banking system. Actually, I would say that these loans should be restructured, should return to banks, because as they currently are, these loans are a burden for the economy, because they keep outside the banking system many businesses, households, and so this would be an important future catalyst and for the sector, and will maintain the profitability of the banks in the future. And I will also add the real estate, actually, because banks have exposure to the real estate sector, either directly through their investments in real estate. Actually, the 4 banks, if I'm not mistaken, have a total of 4 billion of investments in the real estate sector. and also through the collaterals of the loans. So the fact that the prices, the real estate prices have been going up, and the fact that we're entering a period of declining interest rates, which is positive for this sector, it will be also positive for the profitability of banks. So yes, I think that no, I don't think that the sector deserves a discount. Actually, the sector should trade not at a discount to their book values, but at a premium to their book values. I don't know whether my colleagues want to add something more, but these are key. Actually, I put a lot of, I would like actually to stress this thing about this pool of loans outside the banking system, because eventually this will return to banks. So this is quite important for the sector.
Okay, if I may add a couple of points here. First, together with the cleanup of balance sheets that Natasha mentioned, there was also a significant restructuring and cost cutting for many years. So that's why if you look at the cost to income ratio these days is at low 30s in most cases. Second is the fact that during the domestic crisis, credit expansion we had actually credit contraction for many years. So it's only the last couple of years that we are seeing credit growing again, which means that we are at the very early stage of the credit cycle. So that this has two positive implications. One, it is rather unlikely to see anytime soon a new big wave of non-performing loans, and there is an experience with the inflation spike and the interest rates spiked, interest rates going higher. The combination of these two things did not have any material impact in the asset quality of Greek banks. And second, the room for credit expansion over the medium to longer term remains quite big. So hopefully, when interest rates return back to more normal levels, we will see more credit expansion. And the last point here is that we are coming from a period of zero or negative interest rates. We have seen this cycle of interest rate hikes from the ECB. And I think the consensus is that, of course, we will see lower levels in the future, but we will not return to zero interest rates. The consensus is anywhere between 2 to 2.5%, which makes a very healthy environment for any banking system to have some decent spreads and profitability.
I would also agree with Panagiotis and Natasha. I don't think a discount is deserved, definitely, compared to European peers. Maybe because the Greek banks were seen as a rate play and earnings increased substantially in 2023. Some of the investors might consider that these earnings are not sustainable, and this may be a reason that the Greek banks continue to trade at a discount. But I think that once the market realizes that there is sustainability in earnings because of loan growth and the other factors that Natasha and Panagiotis mentioned, I think the market will gradually start to close this gap, and we should see the Greek banks trading definitely at a discount, not trading at a discount, and potentially even at a premium because of this political stability, good macro, lending growth, all these factors, clean balance sheets, all these factors that we mentioned.
Perfect. Maybe looking beyond the large cap companies, maybe I'll put this one to you, Natasha. How deep is the Greek market, and how do you view the small and mid cap names within Greece? You're on mute.
Okay, yes, I'm mute. Actually, there is room for improvement. for sure, because, and for this reason, there has been, we mentioned this earlier, there has been this new revised regulation by Athens Stock Exchange, and among the other things, introduces stricter free float requirements. And the aim is to improve the depth, market depth, liquidity, and marketability. And this should start attracting more long-term investors. And I will mention investors like insurance companies and pension funds. And for these companies, market depth, marketability, liquidity are quite important. So this is a positive move. Also, I would like to mention about a new sector that we see is emerging in the Athens Stock Exchange, and this is a real estate investment trust. We had recently 2 IPOs, the Trade Estate and Noval, and we may see some more activity because some of these companies may want to improve their free float. And this is a quite important sector for the Greek, for Greece, because of the prospects of the real estate market in Greece, and also because of if you expect interest rates coming down, the real estate is one of the market segments that will benefit because of the reduction in yields, and this will translate to capital gains for these companies. And maybe, and also I also mentioned it earlier, that the finance ministry is planning to introduce some incentives, tax incentives and development incentives to make businesses, to grow businesses, to allow business to grow through M&As. And this will be also quite interesting. It will be positive for the market. So apart from these large companies, to see smaller companies growing through these initiatives.
Interesting. And maybe kind of sticking to the capital markets, kind of this pickup in capital market activity we've seen in Greece. You know, Alex mentioned earlier the Athens Airport IPO, the largest IPO since the crisis occurring earlier this year. But on the other hand, we've seen some companies establish dual listings or look to list elsewhere. I guess I'll put this to the panel. What do you make of these seemingly conflicting trends?
Well, I can take this. Yeah. Oh, sorry, Vangelis. Yeah,
no,
please.
it's Alex. Yes, Alex.
Okay, sure. No, I wanted to say that yes, these are conflicting trends, maybe as you mentioned, but we have seen, I think, over the past couple of years that in order to successfully have a dual, first of all, these are dual listings, so most of the companies remain also in the Athens Stock Exchange. Secondly, we have seen over the past 10 years that in order to have a successful dual listing outside Greece, you need to have a significant size. So if you're a company that is smaller, usually you have much more liquidity in the Athens market rather than the primary market of a listing outside Greece, unless you're a very big market cap, of course, and you can get index status in a foreign market, which, of course, that is a different proposition. But in a market, I think you will always have some companies, of course, that will look also for dual listing. If they're international companies, this is totally logical. But the key, I think, is to have new additions in the market, to have increase free flow through placements. So if you have local activity, I think this is healthy and it's part of the market. So I wouldn't see something negative about that overall. Sorry, Vangelis, please. Also.
Thank you, Alex. I totally agree with what Alex just said. If I may add, we have seen recently an example of a company, big cap company, willing to establish a dual listing. And this is Metlen, former Mytilineos, which I believe this decision is related to the company's international growth ambitions and geographical expansion plans. So it can be the rationale maybe a little bit different than previous IPOs of smaller companies in size. And obviously, although the first stage could be a bad thing for the local market, I think it could be somehow offset by new prospective listings, as Alex said. We have, I think, a couple of at least a couple of IPOs in the pipeline, including some mall companies or construction subsidiaries of bigger companies. So there is a potential pipeline that could partially offset this trend.
Perfect. And I know we're running up on time. So maybe my last question to kind of close the webinar. Greece has done well and as we have just discussed, has robust and sustainable drivers in place. Now playing devil's advocate, what potential risks do you see to the investment case?
Well, if I may start with this, I think for the last 2 years, the risks are mainly exogenous. It's I mean, a few years ago, I couldn't imagine that I would say this, but it seems that for the moment, no big risks are present here. We discussed before that the political environment is pretty stable. In the past, that was a source of trouble, if you like, of turmoil in the market. So this is stable. Macro, I don't think that anyone is argues that things will not go well. So I think it is difficult to imagine at this stage a risk that could take place if everything else in the world is okay, that could derail the situation. Obviously, you can imagine things that could slow down or accelerate the trajectory. Tourism, a slowdown or an acceleration. Tourism is a big thing for Greece, as you know. The RRF that we did not discuss, that's the European fund that Greece is a key beneficiary. So absorption of these funds, slower or faster absorption could differentiate things. But I think overall, my belief is that Greece is at a very positive trajectory at the moment. So if anything else around the world is okay, which is not, as we have seen the last few years, but Greek specific risks, I think they are very limited at the moment, the way I see it. I think Greece is at a very positive trajectory at this stage.
Perfect. Well, thank you all. Really appreciate it. And thank you everyone for joining the webinar. Nicholas, I'm not sure if you have any final words, but...
Well, Trevor, we have, I don't know if you want to take any, we have a number of questions that came through. Do you want to take any of those? We have a couple of minutes left. It's up to you, of course.
Oh, yeah, sure. Let me... So we have a question just on the kind of regulatory framework in Greece, and I guess how do you view that in terms of how attractive it is for kind of international investment within the country and for specifically foreign investors?
Well, maybe I could say very briefly. I mean, clearly Greece has, I guess we mean foreign direct investment into the Greek economy overall, not for the Greek stock exchange. In this case, I think that Greece did have a lot of bureaucratic delays in the past, difficulties, but I think that there is a process in place currently that the government is working on solving many of these issues. And we've seen foreign direct investment increasing substantially. From a very low point, it was investment to GDP close to 10%. At the lowest point, it has gone up now to 14%. It's still well below the 20 to 25% of GDP that used to be the average in Greece pre-crisis. But it's clearly moving in the right direction, which means that the ease of doing business in the Greek economy is definitely improving. Maybe not yet at the optimum, but you are in the right direction.
Perfect. And we had a question on debt to GDP ratio in Greece. So maybe just talk about the evolution for that, specifically asking, when this is a concern, but obviously it's been trending in the right direction. So just maybe a general comment on that would be great.
Yeah, well, okay, Natasha, the floor is yours.
Just a very quick, I mean, as long as the denominator is growing, the GDP is growing, then this ratio should improve. So GDP, everything has to do with GDP. So Greece should take advantage of these funds coming from this 90 billion total funding, the RRF plus all the other structural funds that are coming to Greece to take advantage of all this funding to grow the economy and to grow GDP. And this actually the main, this is the most important factor for this ratio.
If I may add, Greece has achieved during the last few years one of the biggest drop in this ratio, debt to GDP, because of the obviously inflation helped on this, but as you pointed out, Trevor, it goes into the right direction. It goes down. It should keep going down for the next few years, at least, given the positive expectations about GDP and the fact that there is fiscal discipline. So at least for the foreseeable future, it should not be a problem.
And if I may remind everybody, our last webinar, last Tuesday, was exactly on the topic of the Greek economy. We had 5 economists with us that talking about exactly what you mentioned. So I urge everybody, if you need more information, to access the link to the replay of that webinar. And maybe with this, I can thank you all for participating. Thank you, Trevor, for being the moderator. Thank you, Natasha, Alexandros, Vangelis, and Panagiotis. It's been a real privilege to have the heads of research of 4 major Greek securities firms share your insight on the market. And I look forward to working closely with you and our Invest in Greece Forum. The 26th version of it will be in New York on December 9, and I hope you will all be here with us. Thank you again very much.
Thank you.
Thank you very much.
Nicholas.
Thank you.
Thank you.